Welcome to the research desk. In the 1 second it takes you, the person listening to this, to just tap your phone against a piece of plastic in a coffee shop, a data packet travels thousands of miles. It hits 5 different financial institutions, and it legally guarantees funds that honestly do not even technically exist yet.
Right. We treat tapping a card as this everyday, completely boring chore. I mean, it is just a reflex at this point.
Exactly, a reflex. But the underlying mechanics required to make that reflex possible are anything but boring. Think about the instantaneous demands colliding in that single millisecond.
Well, let's break that down. The merchant standing across from you wants to know, with absolute mathematical certainty, that the money is good and guaranteed. And they want to know that even though they have literally never met you.
Right. And you, the cardholder, you want the payment to feel utterly frictionless. You want it instant without having to, prove your identity or open a clunky bank app.
Meanwhile, the issuing bank, your bank, needs to approve your legitimate spending while simultaneously halting fraud in real time.
And finally, the acquiring bank, which is the merchant's bank, needs to ensure the payment routing executes flawlessly because, the coffee shop actually needs to get the cash in their account in next morning to make payroll. And Visa and Mastercard sit at the exact center of this collision.
They do. But here's the crucial distinction we have to establish right away for this discussion. They are not conventional banks.
No, not at all. They do not lend you the money, they do not own the merchant's inventory, and they absolutely do not hold your checking account deposits.
They sit at the specific, isolated moment a purchase request has to become a trusted answer.
Yes. And I look at this architecture and I see the ultimate beautiful information machine. My stance today is that Visa and Mastercard have built an inescapable trust switch. Every single authorization message that flows through their system deepens their fraud and risk layer.
I understand the elegance of the engineering, but I look at that exact same machine and I see a toll road facing a massive, unprecedented wall.
A toll road? More cardholders create more merchant, cascading into a broader payments operating system. That system becomes geometrically harder to displace with every passing second.
Sure, the machine they built is undeniably impressive. I am not debating the technical achievement of routing a transaction from Tokyo to New York in 50 milliseconds. But we have to look at the reality of the market right now, today.
What reality are you seeing?
I am seeing that merchants, banks, and regulators are actively trying to bypass these old card rails. They are exhausted. The legal and technological pressure is mounting from every single direction.
You're talking about the antitrust pushback.
I am talking about the Department of Justice stepping in with major antitrust lawsuits, specifically targeting the fees extracted from debit transactions. And it is not just legal pressure. You have the explosive growth of real-time payments, the shift toward pay-by-bank architectures, and entirely parallel rails being built by stablecoins on public blockchains.
I hear you, but you call it a toll road, which implies people are just paying for access to pavement. But to understand why that trust switch is so impenetrable today, we have to look back at the historical chaos that existed before its invention.
You mean the early days of consumer credit?
Exactly. We have to understand exactly why a universal network became necessary in the first place, and why the banks could not just build it themselves. Go back to 1958 in Fresno, California. Bank of America launched the Bank Americard.
Right, the famous Fresno drop.
Yes, and their strategy was something that sounds legally insane today. They quite literally dropped consumer credit into the mailboxes of tens of thousands of customers.
Wait, think about this for a second. They literally mailed live, active credit cards to 60,000 people without modern risk models?
Yes, without credit scoring algorithms and without asking if those people even wanted the debt. They just blanketed the city of Fresno with purchasing power.
That is incredible. And the history recorded by Britannica notes the exact results you would expect from that kind of experiment, right?
Oh, absolutely. Rampant fraud, sky-high delinquency, and major financial losses during the launch period before Bank of America finally tightened their controls. People were taking the cards, buying televisions, and simply never paying the bank back. Criminals were stealing them out of mailboxes. It was total chaos.
And even when it worked, it was incredibly limited.
Right, because they created an entirely local, proprietary, and highly vulnerable system If you took your Bank Card to a merchant in Nevada, it was a useless piece of plastic.
Because the problem they faced in Fresno and immediately after was the ultimate coordination problem. You are dealing with the classic two-sided market dilemma, but elevated to an almost impossible degree.
How so?
Well, it was not simply a matter of getting consumers and merchants to agree to use a piece of plastic. You had to synchronize consumers, issuing banks, merchant banks, payment processors, and network operators all at exactly the same time.
The friction must have been immense.
It was. Let's look at the basic game theory of it. A merchant had zero incentive to pay the fees to accept a card if none of their local customers carried it. And a consumer had absolutely zero incentive to carry a card in their wallet if no merchant in their neighborhood accepted it.
And the early infrastructure to solve this was completely archaic.
Exactly. The Federal Reserve's history on electronic point-of-sale payments details how early interbank settlement was entirely paper-based and bilateral. Imagine what that looked like.
I am picturing a lot of phone calls.
Endless phone calls. When a customer walked into a store to buy a refrigerator, the merchant often had to literally telephone a call center. They would read the numbers off the physical card over the phone to a human operator who would look up the account on a printed ledger to see if the customer had enough credit.
Wow. So real-time authorization was just someone flipping through a book.
Yes, and then the merchant would take a physical carbon copy imprint of the card. At the end of the day, the merchant deposited those paper slips at their local bank. Their local bank then had to figure out how to physically mail or clear those slips with the bank that issued the card.
And that paper-based friction existed because of a fundamental blind spot in the banking industry at the time. The early players thought they were selling a lending product.
Meaning they thought the value was just the interest rate?
Right, they thought the core value was the credit itself, the interest they could charge the consumer. But banks already knew how to lend. They had been lending money for centuries. What they didn't have was a universal commercial handshake.
A handshake to bridge the geography.
Exactly. A merchant who had never met the customer needed to trust a bank it had never dealt with, potentially located in a completely different state. If I am a local hardware store owner in Chicago and someone hands me a piece of paper issued by a bank in Miami, how do I know that Miami bank actually exists?
And how do you know they will actually send you the funds?
Exactly. The only way to achieve that trust was if an invisible, neutral network stood between them, translating the risk and guaranteeing the financial outcome.
That realization is exactly what drove the origins of Mastercard, but they came at it from the opposite direction of Bank of America. It did not start as a monolithic corporate push from a single massive bank trying to dominate the country.
It started as a federation, right?
Yes, it started with regional bankers meeting in Buffalo, New York, to form a federation for reciprocal acceptance. It was originally called Interbank and later Mastercharge.
Why Buffalo?
Because regional banks realized they were geographically boxed in. A bank in New York and a bank in Pennsylvania were issuing their own proprietary cards, but their customers were traveling. So these bankers sat down and realized they needed interoperability, far more than they needed proprietary dominance.
So the plastic was secondary.
Completely. The physical plastic card in the wallet was just the visible artifact. The invisible artifact, the actual invention, was a network architecture allowing bitter, highly competitive banking rivals to cooperate without descending into chaos. They agreed to honor each other's cards, but to do that, they had to agree on the rules of engagement.
And that brings us directly to the structural solution that changed global commerce forever. It was the shift from proprietary islands to institutional governance. Dee Hock, the visionary behind Visa, understood this better than anyone else in the financial system.
He stepped into a massive operational mess, didn't he?
An absolute nightmare. When he was brought in to fix the Bank Card licensee system in the late 1960s, he walked into a back office full of unprocessed transactions. Let me explain what that actually means mechanically.
Please do.
He found swollen suspense ledgers. Now, a suspense ledger is where an accountant parks money when they have absolutely no idea where it belongs. Imagine a bank receiving thousands of paper receipts and the account numbers are smudged, or the merchant ID is missing, or the issuing bank disputes the charge. The money just sits in a bucket unaccounted for.
Just millions of dollars floating in limbo?
Exactly. Hawks saw massive counterfeit risk, delayed settlements, and banks fighting each other over liability. The proprietary islands were failing under their own weight. Hawks' genius was not technical, it was organizational.
Because he decentralized it?
Right. He realized you could not have one bank dictate the rules to all the other banks. So he created a decentralized entity. Member banks could fiercely compete for cardholders and merchants on the front end. They could offer different interest rates, different rewards, different branding, but they were absolutely forced to cooperate flawlessly on the back end.
The clearing and settlement.
Yes. The clearing, the settlement, the security protocols, the messaging standards, they all operated under a single unified immutable rulebook.
And that rulebook turned the network into what we should call a trust interpreter. Think about what a transaction actually is fundamentally. It is not just a binary signal flashing across a screen saying someone wants to buy a coffee.
No, it is incredibly data-rich.
It is a dense package of structured facts. When you tap your phone, you are sending a data payload. It carries the card credentials, the exact merchant identity code, the geographical location, the precise timestamp, the currency, the transaction amount, and a dozen different biometric or cryptographic authentication signals.
And the network is the only entity that can read the whole package.
Exactly. The network takes that specific package, translates it into a universal language, delivers it to the issuer, returns the answer, and simultaneously preserves the cryptographic evidence required for everything that happens after the customer leaves the store. It preserves the data for overnight clearing, for daily settlement, for future dispute resolution, and for risk management.
It makes the transaction perfectly legible to every single participant in the supply chain.
Right. It makes the opaque transparent.
Nearly impossible to break. This is why I argue it is a trust switch rather than just a toll road. This is a multi-party trust market where the incentives align perfectly.
You think the incentives are perfectly aligned right now?
Structurally, yes. It is far more sophisticated than simply saying more users attract more merchants, which is the basic network effect everyone talks about. The real genius is in the mechanics. The price structures, specifically the interchange fees and the assessment fees, and the rules surrounding fraud liability and chargebacks, are precision engineered to balance the market.
Let's talk about interchange, because merchants would strongly disagree about that perfect alignment.
Let's explain how interchange actually works, because people misunderstand it. Visa and Mastercard do not keep the interchange fee. When a merchant pays a 2% fee on a transaction, the vast majority of that money goes to the issuing bank, the bank that gave the consumer the card.
Visa just takes a slice.
Visa just sets the rate and takes a tiny fraction of a cent as a network assessment fee. Why does that matter? Because by giving the interchange revenue to the issuing bank, the network incentivizes banks to issue more cards and offer better rewards to consumers.
Which forces the merchant's hand.
It balances the demand. Consumers get points, so they demand to use the card. Merchants are forced to accept the card because the consumers demand it, and every single transaction feeds the operational knowledge of the network. That knowledge improves the fraud controls and the authorization reliability. The stronger the trust, the more volume flows through the system.
But let's look at the dark side of that exact loop. If the rules are the product, what happens when the people forced to abide by the rules realize they have absolutely no choice but to accept them?
You mean the merchants feeling trapped?
Exactly. That is the exact tension we are seeing right now. When the network becomes unavoidable, the government structure stops looking like a beautiful cooperative ecosystem and starts looking like an inescapable tax on the entire global economy. Merchants do not feel like they are participating in a beautifully balanced multi-party trust market.
They feel like it's a utility bill.
They feel like they are being extorted by a public utility that they cannot legally or practically refuse. Let me ground this in reality. If you run a grocery store with a 2% profit margin and the network charges you a 2% interchange fee on every credit transaction, they are essentially taking your entire net margin on that sale.
But they get guaranteed funds.
But they cannot say no. If you put up a sign saying, cash only, your revenue drops by 60% overnight. The merchants are trapped.
To understand why merchants cannot refuse it and why they ultimately get value from it despite the complaints, we have to walk through the staggering physical scale of the machine in 2025. It operates on 5 distinct gears, and this isn't just theory, this is physical infrastructure.
I know the gears, but walk me through them.
Each gear reinforces the others, making the system incredibly robust. Let's break them down slowly. Gear 1 is acceptance. You just mentioned this. Yes, it is table stakes. A merchant pays the fees because refusing the card means losing the sale entirely. The network is too ubiquitous to ignore. But they are paying for the guarantee of funds. They don't have to run a background check on the customer.
Gear 2 is issuance.
Right. The network allows a local bank to get global reach. A regional credit union in Ohio can hand its customer a piece of plastic, and that customer can walk into a train station in Tokyo, tap it, and it works perfectly. That credit union did not have to negotiate a treaty with the Japanese Transit Authority. The network handled it.
And Gear 3 is where the real data processing happens.
Gear 3 is authorization. This is the absolute heart of their information edge. It is the real-time moment where purchase intent becomes an approved transaction, routed securely across the globe in milliseconds. I like to think of it like an omniscient nightclub bouncer.
A nightclub bouncer that checks everything in 50 milliseconds.
Exactly. When you tap your card, the bouncer doesn't just check your ID. In 50 milliseconds, the bouncer calls your employer to verify your income, calls your bank to check your balance, calls the last 3 stores you visited to ensure you aren't teleporting across the country, and checks the merchant's background to make sure they aren't running a scam. Then the bouncer lets you in.
Which brings us to Gear 4, risk and rules.
Yes, the network has a privileged, horizontal view across all participants. A single bank only sees its own customers, but Visa sees everything. They see the merchant categories, the geographical anomalies, the digital wallet behaviors, and the cross-border patterns. If a fraud ring tests stolen card numbers at a gas station in London, Visa updates the global algorithm instantly, protecting a merchant in Sydney a second later.
And Gear 5 is where they really start monetizing that data.
Gear 5 is value-added services. This is the profound pivot they have made over the last decade. They are no longer just monetizing the basic payment rail. They are turning the data stream into a comprehensive operating system for security, analytics, and open finance. They sell fraud management software, identity verification, and consulting services based on the data they see.
Let's pause there because I want to look at the scale of this.
Listen to the 2025 scale. These numbers prove the physics of the machine. Visa reported $40 billion in net revenue. They processed 257.5 billion individual transactions. That is $17 trillion in total volume flowing through nearly 5 billion active credentials across 175 million merchant locations globally.
And Mastercard's numbers are just as staggering.
Mastercard reported $32.8 billion in net revenue, managing $10.6 trillion in gross dollar volume. The sheer physical reality of this network is completely unprecedented in human history.
Let's stop right there and look incredibly closely at that Mastercard revenue split. Because you just handed me the exact proof of why this is a toll road. Out of that $32.8 billion in net revenue, $19.5 billion came from the payment network, the actual moving of the money.
And the rest?
$13.3 billion came from value-added services and solutions. Think about what that actually means. They aren't just taking a toll for access to the road anymore, they are selling the data exhaust back to the ecosystem.
That is just smart business scaling.
I mean, they observe the transactions, package the insights, and sell the security and analytics back to the exact same banks and merchants who generated the data in the first place. You called it an operating system, I call it double dipping.
I wouldn't call it double dipping. It's providing an essential security layer.
That does not make them a benevolent trust switch. That makes them an inescapable monopoly, leveraging its gatekeeper status to dominate entirely adjacent markets. They force you to use the rail, they collect the data from your usage, and then they charge you a premium to access the insights generated by your own customers.
I understand the frustration from the merchant side, but is it actually a monopoly, or is it simply the only trust layer that mathematically works at that scale? If building a global, instant, mathematically secure clearing system was easy, someone else would have done it.
Well, the United States government fundamentally believes it is a monopoly. The toll road has become a massive, highly visible target. We are not just talking about angry small business owners anymore. Look at the interchange fights at the highest levels of regulation.
The DOJ action?
Yes, merchants are furious over the honor all cards rules. Let me explain that mechanism. The network rules dictate that if a merchant accepts a basic Visa debit card, they're contractually forced to also accept the ultra-premium Visa Infinite Rewards credit card.
which carries a higher cost.
Much higher. The merchant cannot discriminate, but the interchange fee on that premium rewards card is drastically higher, sometimes approaching 3%. The merchant is stripped of the ability to steer customers to cheaper payment methods.
But that is what funds the consumer rewards.
The Federal Reserve's debit data lays this extraction out clearly. In 2023, covered and exempt debit card transactions hit $100.7 billion. That yielded $34.12 billion in interchange fee revenue. That is just debit, money that is already sitting in a consumer's checking account.
Yes, debit is a different risk profile than credit.
It is the staggering extraction of wealth from merchants for moving money that carries zero credit risk. And this anger culminated in the September 2024 Department of Justice antitrust lawsuit against Visa.
The DOJ case on monopolization.
The DOJ alleged monopolization and unlawful conduct in the debit market. They pointed out that over 60% of U.S. debit transactions run on Visa's network, charging over $7 billion in fees annually. The wall they are facing is legal, it is structural, and it is formidable.
The DOJ lawsuits are aggressive, certainly, but they target the symptom, not the underlying architecture. The government is looking at the price tag without understanding the machine.
How so?
Merchants constantly complain about the fees, but those exact fees fund the trust layer that guarantees the merchant gets paid without assuming the fraud risk. Let's look at what would happen if you stripped those fees away entirely. Who pays for the tokenization?
Tokenization is software, it's not physical infrastructure.
Let me explain how tokenization works, because it is the bedrock of modern digital security. When you load your card into Apple Pay, Apple does not store your actual 16-digit card number on your phone. If they did, a hacker could steal it.
Right. They use a token.
Instead, Visa generates a unique token, a meaningless string of numbers, and locks the real card number in a heavily encrypted vault. When you tap your phone, you are sending the token. The merchant only sees the token. Even if the merchant's entire database is hacked, the hackers get nothing but useless tokens.
And you were saying the fees pay for that vault?
That architecture costs billions of dollars to maintain. The fees fund that tokenization. The fees fund the zero liability protections that allow a consumer to confidently shop online without fearing they will lose their life savings to a scammer. The fees fund the instantaneous clearing that makes modern commerce possible. You cannot simply separate the cost of the network from the immense economic value of the trust it provides.
If the network is so fundamentally valuable on its own merits and merchants are so happy with the trust layer, we have to look at the Plaid episode. This is the clearest evidence that Visa knows their toll road is vulnerable.
The Plaid acquisition block.
Yes. In 2020 and 2021, the Department of Justice sued to block Visa's acquisition of Plaid for $5.3 billion. Let's explain why Visa wanted Plaid in the first place. Plaid is a technology company that connects consumer bank accounts to financial apps. They enable account-to-account payments.
Pay by bank.
Exactly. This means you could potentially pay a merchant directly from your Chase checking account to the merchant's Bank of America account, completely bypassing the plastic card. This architecture threatened to move transactions entirely outside the traditional card route. The network would never see the transaction, and they would never collect the interchange fee.
That is a theoretical bypass, though.
So I have to ask you, if the network's trust layer is so inherently valuable and impossible to live without, why did Visa attempt to spend over $5 billion trying to buy out a nascent threat?
Because they wanted to expand their network of networks strategy.
They eventually abandoned the deal under DOJ pressure because the strategic signal was glaringly obvious. The DOJ's complaint explicitly cited internal Visa documents where executives described Plaid as an island volcano that could erupt and threaten their debit business. Visa recognized that alternative routing options could bypass their toll road entirely. They tried to buy the bypass to shut it down.
I will concede that the DOJ blocking the Plaid acquisition spooked them. It proved the perimeter of their empire isn't entirely secure. It showed that account-to-account payments are a real technological possibility.
A massive possibility.
But here is why I think their response to that threat actually strengthens my point. Despite the Plaid deal falling through, Visa and Mastercard continue to process absolute record volumes year after year. Why? Because the technology bypass is much harder to execute in practice than it is in a white paper.
The rails are already built, though.
You can build new rails to move money, but rails alone do not solve the trust problem. Moving a dollar from point A to point B is a commodity. Protecting the buyer and the seller during that movement is an incredibly complex service.
But the new rails are not just white papers anymore. They are fully operational, they are live, and they are scaling aggressively. We're looking at pure technological disruption through systems like real-time payments, FedNow, and stablecoins.
The volume on those is still tiny compared to cards.
Let's look at the mechanics of the alternative rails. The clearinghouse's real-time payments network, RTP, offers instant settlement, and crucially, it uses rich ISO 20022 messaging. Let me explain the difference, because it matters.
The messaging standards.
A legacy magnetic stripe ping on a card network carries very little data, basically just an account number and a dollar amount. An ISO 20022 message carries a massive payload of structured data. It can carry an entire itemized invoice, remittance information, and business logic attached directly to the payment.
It is a better messaging standard, yes.
As of the data extending into early 2026, the RTP network has a $10 million transaction limit, over 1,200 participating financial institutions, and processed 128 million transactions, totaling $480 billion in a single quarter.
Which is impressive for B2B, but not consumer retail.
Then you have the government's version, FedNow. FedNow reported 8.4 million settled payments worth $853.4 billion in 2025. These are credit push systems. The consumer pushes the money directly to the merchant. If merchants can get paid instantly and directly from consumers' bank account with rich data attached, the card network's core job as a middleman is completely bypassed.
They are not being bypassed, they are actively co-opting the disruption. Visa and Mastercard are not sitting in their corporate headquarters watching these alternative rails develop and doing nothing.
They are trying to catch up.
They are aggressively absorbing them into their own infrastructure. Let's look at stablecoins, which you mentioned as a parallel rail. Visa announced U.S. stablecoin settlement in December 2025. They rapidly hit a $3.5 billion annualized run rate settling transactions in USDC over public blockchains.
Settling on Solana and Ethereum, right?
Let's explain how that works. Usually, Visa settles with acquiring banks using traditional fiat currency over legacy wire systems. Now, they are using Solana and Ethereum to move digital dollars instantly, 24/7, without waiting for the traditional banking system to open on Monday morning. They're using the blockchain as a back-end settlement rail.
So they are renting the new rails.
Meanwhile, Mastercard is aggressively integrating real-time account-based payments and open finance into their value-added services. They are leaning into the disruption because they deeply understand their own business model. Their core product isn't the physical plastic card. Their core product isn't the legacy magnetic stripe rail.
Moving money is just the baseline.
Moving money is a commodity. Moving money is not the same as making commerce trusted. I ask you again, can a real-time payment rail like FedNow handle predictive fraud controls, administer millions of consumer chargebacks, and orchestrate global airline loyalty point integrations the way the 5 gears of the card network do?
It doesn't have the dispute framework built in yet.
If I push money to a scammer on RTP, the money is gone. There is no chargeback button. The card network provides the chargeback button.
That assumes the market requires the 5 gears and the chargeback button for absolutely every single transaction in the economy. Let's step back and look at the broader business pattern here to understand what the networks actually own and where they're vulnerable.
Exactly. The pattern is owning the decision threshold. Visa and Mastercard share a structural parallel with the greatest information businesses in the modern world because they own the trust moment.
Walk through the parallels.
Think about the parallels. Google owns the exact moment a typed question becomes search intent. Amazon owns the exact moment browsing intent becomes a final purchase. Bloomberg owns the critical moment before a financial professional executes a market action.
And TSMC owns the moment a chip design becomes physical silicon.
Right. TSMC owns the moment conceptual chip design becomes physical yield. Visa and Mastercard own the precise moment a payment request becomes trusted commerce. They do not just own data, they own decision data. And decision data has 4 highly specific properties that make it incredibly lucrative.
I assume time is the first one.
First, it is time sensitive. A fraud signal generated 3 hours after a transaction is an autopsy. You already lost the money. A fraud signal generated during the 50 milliseconds of authorization is infinitely more valuable because it prevents the loss.
Second would be the structure of the data.
Second, it is structured. They do not see vague, unstructured behavioral data like a social media company does. They see standardized, globally uniform messages with exact amounts, merchant category codes, routing fields, and risk contexts.
Third is the scale.
Third, it is repeatable. Processing hundreds of billions of transactions creates an unparalleled statistical map of normal and abnormal global commerce. They know what a normal Tuesday looks like in Paris, and they know when a transaction deviates from that baseline.
And the fourth property.
Fourth, it is actionable. The data directly changes the physical outcome in the real world. The network's intelligence dictates whether to approve, decline, challenge with a 2-factor text message, or tokenize the transaction. That decision threshold is the moat.
I agree that the pattern holds perfectly for the past 40 years, but I question the future of that specific threshold. The landscape of how we authenticate ourselves and how we settle value is shifting beneath their feet.
The mobile wallets, you mean?
Let's look at how the payment event is being unbundled. If I use my iPhone to buy something, Apple handles the biometric authentication. They scan my face. Apple knows I am who I say I am. The legacy network is no longer providing the ID verification.
But the network still routes the token.
Now, what if the settlement happens on a real-time payment rail or via a stablecoin? If the wallet handles the identity and the new rail handles the instant settlement of value, the legacy network in the middle is entirely abstracted away. They become a vestigial organ.
I think that underestimates the complexity of dispute resolution.
I will ask you a practical question. Does a corporate payroll payout or a low-risk treasury transfer between 2 known businesses, or a person paying their utility bill, actually need the full expensive trust stack? Not every movement of money requires consumer chargeback rights and global loyalty point integration.
But consumer retail always will.
As the fundamental payment event gets unbundled into separate components, authentication, routing, and settlement, the absolute necessity of the network's expensive trust layer diminishes for a massive percentage of everyday transactions. The toll road becomes optional.
That brings us to our final positions on the underlying architecture of global money. My conclusion is that Visa and Mastercard will successfully evolve into network of networks companies.
You think they just sit on top of everything else?
They are too embedded, too well capitalized, and too technologically adaptive to be bypassed. They will elevate themselves above the physical plastic cards, above the digital mobile wallets, and above the underlying stablecoins. They will provide the ultimate trust fabric.
The global standard for trust.
They will provide the identity verification, the tokenization standards, the predictive risk scoring, and the legal dispute frameworks wherever value moves, regardless of the rail it moves on. The plumbing may change, but the necessity for a trusted neutral intermediary to resolve uncertainty at global scale will only increase.
And my conclusion is that while these companies will certainly not disappear tomorrow, the fundamental payment event is being irreversibly unbundled. The monolithic swipe is breaking apart.
It is fragmenting.
Authorization, identity verification, fraud scoring, and final settlement are being pulled apart and managed by localized, specialized players or public infrastructure. Their legacy economics, which rely heavily on extracting a percentage toll from every single swipe, may not perfectly transfer when the swipe itself is no longer the center of the financial system.
The economics will definitely face pressure.
The future isn't necessarily about replacing Visa and Mastercard overnight. It is about forcing them to prove that their trust switch is actually worth paying for when the underlying rail completely changes and merchants finally have a choice. This is the Research Desk, officially signing off.